After an extremely volatile year of 2018, stock market investors are looking forward to 2019. Dr. V.K. Vijayakumar, the Chief Investment Strategist of Geojit, will talk about the prospects of 2019 and the investment strategies. Welcome, Doctor.
Thank you.
2000 year was a year of volatility. So, what are the prospects of 2019?
2018 was a year of not only volatility, a year of poor returns for stock market investors. Even though Sensex and Nifty gave positive returns of more than 5% and more than 3% respectively, the broader markets performed very poorly. The small cap index and mid cap index both performed very poorly. Retail investors normally have a high weightage of their investments in small and mid cap stocks. Therefore, from the perspective of retail investors, the returns were very poor. Actually, 8 out of 10 stocks declined and 6 out of 10 stocks declined by more than 25%. But then it is normal. In stock market, you will not get very steady and returns will never be linear. Returns will be cyclical. Certain years we will get excellent returns. For example, in 2017 the returns were excellent. During certain years the returns will be normal, and there will be years of no returns, and once in 5 years even negative returns. So that is par for the course. 2019 looks promising. There are many reasons for that. I will just summarize 3 reasons why 2019 would be a promising year for stock market investors. Globally, there is a concern regarding global economic growth this year. That is not a good news as far as corporate earnings and exports are concerned. But paradoxically, from the market perspective, a global economic slowdown can be good for the market. The reason is the US is slowing down, and when the US economy slows down, the US central bank, the Fed, will not be cutting interest, will not be raising interest rates as everyone expected it. In 2018, the Fed raised interest rate 4 times, and a couple of months back the general consensus was that the Fed will raise rates 3 times in 2019. But that is not even a remote possibility now. The Fed will raise rates maximum by 2 times in 2019, perhaps only once. That is good news for emerging markets like India, because money will flow from America to emerging markets like India. Already the 10-year bond yield in the US has come down from a high of 3.26% in October last year to 2.7% now. So economies, emerging market economies like India will benefit out of foreign portfolio investment inflows. That is something very positive. Secondly, from India's economic perspective, we are on the cusp of a spurt in corporate earnings. And next year, 2019-20, I am talking about financial year 2020. Financial year 2020 is likely to witness sharp spurt in Nifty earnings by more than 20%. So the market will start discounting that in advance. And thirdly, we are from the macro perspective in a sweet spot. The crash in crude is a major tailwind for the economy. And more specifically, inflation has come down drastically. Inflation last year in January, the inflation target was around 5.07%, but we ended the year in December with a CPI inflation of around 2.13%. So that means there is room for the RBI to cut interest rates in 2019. That augurs well for these markets. So cumulatively all these factors will be favorable for the market, and that is why we are expecting decent returns for stock market investors in 2019.
Okay. On February 1st, we are going to have the union budget. So how is these budget proposals going to impact the stock market?
Well, a budget is a very important policy document, and it will certainly have its impact on the market. What will be the impact of the budget on the market will depend on the budget proposals themselves. But a very important point that we have to understand is, since 1991 we have stability in economic policy in India, and therefore budgets do not make major policy changes. There is continuity in policy, but then budget is important. This year's budget particularly is very important because this will be the last, it will not be a full-fledged budget, it will not be a vote on account either, it will be an interim budget, that is the precedent. And this budget would be the last budget of the present Modi government, and therefore politicians will always use the budget as an instrument for achieving their political goals also. As Bismarck famously said, politics is the art of the possible, therefore you can use the fiscal instrument, that is the budget, for winning over the electorate onto your side. But then there is a concern as far as the market is concerned. There is a chance that the government might become a little bit fiscally profligate, fiscally loose, and that might increase the fiscal deficit. There are a little bit of some concerns, some serious concerns in the economy now. One is the farming community is facing a major crisis, and the government is already, actually the finance minister has gone on record saying that there can be some major initiatives in the budget to address this issue, even though he did not spell out the details, which he can't. So you can expect some big announcements as far as the redressal of the farmer grievances are concerned. Also, there is likely to be a big bang announcement regarding a basic income scheme, a basic income for the really backward poor people. That can be a vote gathering, vote fetching initiative. But the problem with such initiatives, and also there can be sobs for the middle class in the form of exemption of income tax limit, etc. These are all fine, but then the concern of the market is if the spending goes beyond a limit, if fiscal profligacy goes beyond a particular limit, the market will react, because the government does not have the fiscal space to spend too much. Already they have a fiscal deficit target of 3.3% this year and 3% for the financial year 1920. So the government doesn't have the fiscal space to go for an aggressive public expenditure program. So if some big bang programs like this are announced, and if the fiscal deficit widens beyond the safe limits, the bond market will react. Already the 2018 10-year bond, the yield on that 10-year bond, which came down to 7.25 recently, has already inched up to 7.6. The market is giving the indication that the government will be borrowing excessively and the cost of capital will go up. That can be a little bit problematic.
After the union budget, the next most important event on 2019 is the general elections. How important are these general elections on the stock market perspective?
Yes, elections are very important, because after the elections you have a new government, and the new government will have its own new economic policy, and that will have its ramifications on the market. But our experience is that since 1991, elections do not have much long-term impact on the market. Yes, there will be short-term hypersensitivity towards election outcomes. The markets may react very violently, positively as well as negatively, depending upon what the market expects and what actually we get after the elections. But since 1991, the long-term impact is negligible. The reason is, since 1991 we have stability in economic policy. If you take the year 1991 till now, we had 8 governments under 6 prime ministers, right? But then the economic policy did not change. Before 1991 it was a different scenario. So long-term impact is negligible, but the short-term impact can be very disruptive sometimes. In 2004, in 2009 also it happened. So short term impact can be huge, but long run negligible. And also there is a popular misconception in the markets that single party rule is better than coalitions. That is wrong. Actually in India, coalitions have delivered superior economic growth, superior corporate earnings, and naturally superior market returns also.
Okay, so you told about the general importance of the elections on the stock market. So what do you see as the outcome of the coming general elections, and how it is going to impact the stock market?
Yes, the coming elections are very important. About a year back, there was almost a consensus that the present dispensation will come back to power. But that is not the scenario right now. There is no clarity on the election outcome now. It is going to be a tough fight, but I think we can visualize three different scenarios. First one is the present government coming back to power with a slightly reduced majority. The second outcome is, a probable outcome is, a coalition headed by the Congress assuming power. The market will be okay with these two outcomes. But there is another scenario, and that is a regional party, a powerful regional leader heading a third front government. For instance, in 1996 we had a government headed by Deve Gowda, which did not complete 1 year in office, followed by a government of IK Gujarat, which also was very unstable. So if you have a regional party heading the elections, heading the government, supported by the major party from outside without participating in the government, that would be a scenario which the market may not like, because such a coalition would be inherently unstable coalition. It can be a quarrelsome, cantankerous government, and it would be difficult for such an unstable coalition to implement a stable economic policy. So this third outcome, it is not a remote possibility in the current context. So in the first two outcomes, the market will be happy, but the third outcome, in the unlikely event or the likely event of that materializing, the market, in my opinion, will respond very negatively. I won't be surprised if there is a 10% correction in the market if that happens. More than 10% correction in the Nifty is possible if it is a third front government without a major party participating in that government.
So how should the investors approach this imminent volatility in the stock market?
Well, our experience for the past during this last several elections is, if investors bought before the elections, they made money, because markets have an uncanny ability to anticipate the outcome and discount the outcome. So going by previous experiences, investors who buy before the elections have already made money, have always made money. But then you cannot expect that to repeat this time also. So I told you about the third scenario, which can lead to a sell-off in the market. That means investors should keep their powder dry. They should not be completely invested at the time of the elections or on the eve of elections. If a sell-off happens and the market corrects, they should have enough ammunition to buy stocks, because if there is a sell-off, good quality stocks, blue chips will be available at a bargain, and that opportunity should be utilized. Otherwise, investors should manage this stability, manage this imminent volatility with a stable investment. Investors should continue with their systematic investment plans. They should scale up their SIPs if possible. They should continue to invest in good quality stocks. And I referred to the big declines in small and mid cap indices that we experienced last year. So mid and small caps are attractively priced now. Therefore, long-term investors can think of making investments in mid and small caps, even in bulk amount, need not be SIPs. That investment need not fetch very good returns immediately, but then historically mid and small caps have outperformed large caps if you have a 5-year, 10-year horizon. So investors with a 5-year horizon can even invest in bulk in mid and small caps, ideally through the mutual fund route. In brief, you should manage this volatility with stable investment.
Thank you for giving our prospects for 2019 and for giving the investment strategies for the investors to watch out for.
Thank you.
Thank you,
It was
sir.
my pleasure.
Thank you.